Hi, thanks for joining. In this video, we're going to be covering one of my favorite indicators, the stochastic oscillator. So what is the stochastic oscillator? It's a momentum indicator that compares the closing price of an asset to its high-low range over a set number of periods. And the basic premise of the indicator is that momentum precedes price. So this means that it could signal an actual movement before it happens. The stochastic oscillator was developed by George C. Lane in the late 1950s. He believed that momentum changes before price, so he created the stochastic oscillator to follow the speed or momentum of the price. And the idea behind the stochastic indicator is that the momentum of an instrument's price will often change before the price movement of the instrument changes direction. And as a result, the indicator can be used to predict trend reversals. The oscillator works on the theory that in an uptrend, the next price will be equal to or above the previous price. And similarly, in a downtrend, the next price will be equal to or below the next closing price. If the closing price tends to slip away from the high or the low, it means that momentum is possibly slowing down. So how does the stochastic oscillator work? It is basically a two-line indicator that can be applied to any chart. It fluctuates between 0 and 100. The indicator compares the closing price to the highest and lowest price levels over a predetermined time period. The previous time period usually consists of 14 previous periods. If you're looking at a weekly chart, it is the last 14 weeks, and if you're looking at an hourly chart, it'll be the last 14 hours. When the stochastic oscillator is applied, a white line will appear below the chart. This white line is the percent K line. There will also be another line on the chart, and this is known as the percent D line. And the percent D line is the 3-period moving average of the percent K line. So it essentially smooths out the K line like a moving average does. So when the stochastic oscillator is at a high level, it means that the instrument's price closed near the top of the 14-period range. And when the indicator is at a low level, it signals that the price closed near the bottom of the 14-period range. Like the relative strength index, the stochastic oscillator can indicate when an instrument is oversold or overbought. So how do you read the stochastic oscillator for overbought and oversold conditions? As you can see here, the 80 and the 20 are the most common levels used. In general, the area above 80 indicates an overbought region, while the area below 20 is considered an oversold region. And as a general rule of thumb, we buy when the market is oversold and we sell when the market is overbought. However, you have to be cautious because overbought and oversold labels can be misleading. An instrument won't necessarily fall in price just because it is overbought. And similarly, an instrument won't necessarily rise in price just because it looks oversold. With the stochastic oscillator, overbought and oversold simply mean that the price is at its high or low compared to the previous 14 or whatever time period you've chosen. And as you can see, these conditions can last for extended periods. To create more precise trading signals, traders often use the crossover signal. As you can see here, a crossover signal occurs when the two lines cross over in the overbought or oversold regions. So essentially, a sell signal occurs when a decreasing percent K line crosses below the D line in an overbought region. And a buy signal, on the other hand, occurs when an increasing percent K line crosses above the D line in the oversold region. And these signals tend to be more reliable indicators than simply buying or selling when the market is overbought or appears to be oversold. Some traders say that the most reliable way to use the stochastic is with the divergence method. But you should be aware that this happens more rarely than crossovers or the price being in the oversold or overbought region. Divergences occur when the price makes a new high or a new low, but the oscillator does not follow suit. It appears to be doing the opposite. A bullish divergence forms when the price makes a lower low, but the stochastic oscillator forms a higher low, and this indicates less downward momentum and a potential bullish reversal. On the other hand, a bearish divergence forms when the price makes a higher high, but the stochastic oscillator forms a lower high. This indicates less upward momentum and signals a potential bearish reversal. An important point in the divergence strategy is that the trade should not be made until it is confirmed by an actual turnaround in the price. And this is because the price can continue to rise or fall for a very long time, even while the divergence is occurring. Overall, the stochastic oscillator is a very popular technical analysis tool, but it does have its limitations. It can produce false signals, particularly when the market is very choppy. As always, you should practice good risk management and continue to educate yourself. Thanks for watching. If you enjoyed this video, please like and subscribe. And if you have any questions, please send them through to us. Our website is fxscouts.com.